Good morning and a warm welcome to Lovell Consulting's webinar on how to get tax refunds from HMRC when you incur capital expenditure, buying buildings or fitting out refurbishing property. I'm John Lovell, Director of Lovell Consulting. It's a firm that I set up 23 years ago. I have a background as a chartered surveyor, also as a tax advisor. I worked with a large firm of accountants and have specialised in this area for 23 years. It does say on the seminar that I'll be joined by my colleague Richard Massingham. Richard has decided he won't be presenting today, and I think that's because I had mild corona a few weeks back and he doesn't want to be in the same room. So I'm afraid you're going to have to listen to me for the duration of this. If anybody wants CPD certificates, please email us at the end of the seminar and we will send CPD certificates to you. And if you have any questions about anything that we cover or we don't cover, again, please email through your questions and we will send replies, anonymous replies, at the end of the seminar. So I think most of you have joined now. Thank you for listening. We have a good number of people attending this webinar. So I'm going to start just by very simply, how do investment allowances, capital allowances work? Now, essentially, all governments have given tax incentives to encourage investment in the UK economy. And doesn't really matter what kind of government, whether it's Conservative or Labour or coalition, pretty much every government sees a benefit in encouraging and stimulating investment in the UK economy. And one of the main ways that they do this for construction, property expenditure is through the capital allowances system. I think it's fair to say that the UK has a very generous tax regime when you make international comparisons. And one of the very unusual features about the UK capital allowances system is you can keep these allowances. So even if you sell a property, if you structure the transaction properly, you can keep these tax incentives so that they're an absolute saving. In most other countries around the world, the tax incentives which are given are generally clawed back when a property is sold. So the UK is very generous in that respect, and that applies to most of these allowances. Now, how does it work? So as you can see in option 1 on the left-hand side, if you had a property business, or it could be any business, it could be a chain of hotels, and let's supposing that they had profits, rental profits or trading profits if it was a hotel, and let's suppose they had little bank debt and they hadn't claimed any capital allowances, then in very simplistic terms, they would have high taxable profits. There would be few deductions from those profits, and they would pay, as you can see, very substantial amounts of tax each year. And the amount of tax they pay would depend on the structure that they hold that property or company in. Now, the situation that most individuals and most companies try to get to is more like option 2. So they have exactly the same profits of $1 million, but you can offset bank interest subject to caps, and you can offset capital allowances. And the combination of capital allowances and bank interest is very potent and very substantially reduces the taxable profits, and as a result there's a lot less tax to pay. So essentially, by listening to this webinar, we're going to go through some very practical, simple case studies, and the objective is to try to get into the option 2, where you're minimizing the amount of income tax or corporation tax that needs to be paid. Now, I would like to say this is completely legitimate tax planning. There's nothing artificial about what we're talking about. It's very much what all governments have encouraged, that they are happy to give a tax incentive on the back of investment, buying buildings, constructing, fitting out, refurbishing property. So these are tax incentives which all governments want you to take advantage of. Now, in practice, they can make it quite complicated in terms of the rules. And if you listen to this webinar, hopefully you'll understand, and through the case studies, we will clarify and demystify this process. So at the moment, well, it's challenging times for almost all individuals and companies. And what we're finding is wherever possible, people want to get repayments of tax back from HMRC. So a lot of capital allowances shelter future profits. So since Corona came along, the focus very much has been to try wherever possible to get repayments of tax. And we have a number of case studies here which I'll go through, which will explain how it is possible in certain situations to get repayments of tax. Now, in this first example, it was a company in the leisure sector, and they had a very successful leisure business, making substantial profits. And they had been paying corporation tax on account in installments. So they'd actually made advance payments of corporation tax before the tax return was actually due. This was a large company. So they'd paid $500,000 of corporation tax. Then they were hit by Corona. They had to completely close, very difficult trading conditions. And they came to us and said, is there anything that you can do? Now, we looked at the tax computations, the tax returns that they had made, and pretty much straight away, we spotted that they had missed claiming a lot of legitimate capital allowances, that they had a lot of payments to building contractors. It was a design and build contract, and they just had a pile of invoices that said building works. And their poor accountant, poor tax advisor, was just given this pile of invoices with no further breakdowns. Now, we were able to do a specialist analysis. We, despite Corona, we were able to visit the property, take photographs. We managed to piece records information together. There were quite poor construction breakdowns. So as quantity surveyors, we made a lot of assessments, and we identified extra capital allowances of $4 million that had not been claimed. We then worked with the accountant tax advisor to amend the tax returns that they'd previously submitted, and this resulted in a repayment of $300,000 of corporation tax. And it will also result in future tax savings going forwards, up to I think about $800,000 in total. So immediate repayment of $300,000 with a further $500,000 shelter for when they start trading again in the future and start making taxable profits. So this was a substantial benefit to the company, and we're doing quite a lot of work on this basis with individuals who bought buildings or spent money on commercial property, and with companies, just to see if there is the opportunity. Now, normally you can go back 1 to 2 years to get repayments. You can go further back than 2 years, but this is not possible normally to reopen tax returns from more than 2 years ago. But let's suppose that someone bought a building 10 years ago, maybe didn't claim all the allowances 10 years ago. Provided they still own that building, they can claim allowances in a current or open return. But it's a little bit harder to trigger repayments for properties which are older, unless they've paid tax on those profits in the last 1 to 2 years. But it is possible to go back further than 2 years. Second example, again, this is a real case study. A property developer here who'd held a property as trading stock. It was predominantly residential with some commercial, and it had been a heavily contaminated site. So the prior owners of the site, there was asbestos, arsenic, cyanide, really nasty stuff in the ground, and the developer had to remediate that site. Now, there is a special tax incentive in the UK for remediating land and buildings, and this applies not just to property owners or property investors. Unusually, this tax relief applies also to property developers. And by segregating the costs, making a lot of assessments, working with the project team, we were able to identify an extra 14 million of contaminated land relief expenditure that had not been claimed in the tax returns. Now, if the company here, if they had been profitable, they could have triggered a repayment of tax that they paid, but in this case, they were loss-making. Now, for this specific type of tax relief, land remediation, even if you have tax losses, it is possible to surrender those remediation allowances and get a cash repayment. So in this example, the developer got a cash repayment of 3 million, just over, which was again very helpful to them in these economically challenging times. But even in good economic times, he wouldn't be happy with a substantial tax saving of those figures. This was quite a big case. It does apply equally where the numbers are substantially smaller. Another very recent example, we did some work for a private school. They had bought what was previously an office building, paid 10 million for it. They then refurbished it, spent another 2.5 million fitting it out, refurbishing, and they hadn't claimed any allowances. Now, it is possible in a lot of cases to claim allowances twice. So if you bought a freehold building or long leasehold building, you may be able to claim part of the purchase price. And we identified that there was plant in the building, like heating, lighting, which had not been claimed by any previous owner. So we were able to bank 2 million of allowances out of the 10 million that they paid for the property. And we were able to get allowances in full on all of the 2.5 million that they'd spent through a mixture of plant, repairs, structures and buildings allowance. Now, again, this school, they had been trading successfully pre-corona, and they had made tax payments, and we were able to amend those tax returns because they hadn't claimed these allowances, and the school was able to get an immediate repayment of tax back from HMRC of 400,000, and they will have future tax savings to offset into future periods when they're able to retrade post-corona. So I think what we're trying to illustrate is in these challenging times, it is worth revisiting historical expenditure, because what we find in practice is unless you or your clients have engaged and worked with a capital allowances specialist, it's unlikely that all of the allowances will have been picked up, and it's possible to make additional claims quite legitimately. Another example, there are special tax incentives that applied up to April 2020 if you had energy efficient plants and machinery. Now, in this example, it was a high street retailer they'd spent £1 million replacing light fittings in their stores. The lights that they'd replaced them with were energy efficient, so they qualified for 100% capital allowances. And we segregated the costs, and we managed, you're probably wondering why it went from 1 million to 1.2 million. That is because it is possible to attribute things like architects' fees, surveyors' fees, builders' working connection, contractors' overheads, preliminaries. So the 1 million in tax terms was worth 1.2 million. Like a lot of high street retailers, this one had tax losses, and they were able to surrender the capital allowances losses to trigger a repayment of cash back from HMRC. And in this example, they got cash back of 150,000. It was not the full value of the tax relief. In this example, HMRC kept 1/3 of the benefit. But it is possible for expenditure on energy efficient equipment that was incurred pre-April 2020 to either get extra allowances or to get cash back from HMRC. You might be wondering, well, why are these opportunities missed? These all seem quite straightforward examples. Capital allowances have been around for a long time. So why are accountants, tax advisors, property lawyers, why are they missing these allowances? And it's a very good question, and is normally because in practice the information is not neatly segregated. So when you buy a building, there may not be anything at all mentioned about capital allowances. So if a purchase contract is completely silent, no accountant is going to then file a capital allowances claim. So it's a valuation process, it's a forensic process when you buy buildings. And the same when you incur expenditure. If there's invoices which are very nicely described, and you have an invoice that says air conditioning 50,000, then every accountant will know to claim 50,000 worth of capital allowances. The problem is the invoices that are not detailed, so they just say building works or as valuation or as architect's instruction with no detail behind it. And that is why a specialist can normally get extra allowances. So the other thing as well is property lawyers are not valuers, and if the seller says, here is a capital allowances tax election, the buyer can have 50,000, then a lot of property lawyers will accept that in good faith, and the buyer will then have a piece of paper, a tax election that says the buyer is entitled to allowances of 50,000, and those are the only allowances that will be claimed. Whereas a capital allowances specialist working behind the scenes with the property lawyer can ask the right questions. They may find that the previous owner hasn't claimed all of the allowances that they were entitled to. The capital allowances specialist can work with the lawyer, tweak the wording in the contract so that the buyer can benefit from a lot more allowances. And one of the key takeaway points I'd like to take from this webinar is review earlier acquisitions and construction expenditure. Most of us now have got a lot more time than we've ever had, a lot fewer transactions happening in real time. So this is a great opportunity to revisit those transactions in the boom periods. So look back and see what allowances were claimed in the past and see if there is any scope to claim more allowances. As a specialist firm, we don't charge to ascertain whether there is any scope for more allowances. We don't need a lot of information. The information that is needed is minimal, and we can be very quick and then come back and say, look, we've done a high-level review of expenditure in, say, the last 6 years, and we reckon that we can get extra allowances of this, and this is what the fee basis will be. So pretty much any competent capital allowances specialist firm should be able to do that. And we find quite often that if people have used complex structures in the past to buy buildings, such as J-puts, which were fashionable for stamp duty planning, quite often with a J-put, you've got mixed ownership. Some of the owners may be tax-paying, some of them may be non-tax-paying. And very often we find that people just only inherit the capital allowances from the tax-paying proportion, and there's an opportunity to claim extra allowances for the non-tax-paying former owners. So that's just a simple example. But as a specialist, we can do quick, efficient reviews of historical expenditure to spot these kind of opportunities. Another case study here. These are actual examples, and they kind of set out and explain why capital allowances are not always picked up. So in this first example, someone's bought a building and they've paid 5 million. Now, the former owner in this example was a non-taxpayer. So somebody like a charity, somebody like a pension fund, a government entity. So non-taxpayers do not claim allowances. They're not entitled. So the poor old lawyer and the poor old accountant, all they would have is a purchase contract that just has nothing in it about capital allowances. Or if they're lucky, it might have a statement that says the former owner was a non-taxpayer and has not claimed allowances. So in most cases, unless a specialist was involved, there would be no allowances picked up out of the 5 million, purely because the purchase contract is silent. As a specialist, we can look back at the history, check back the former owners, and then do a valuation process, visit the building, segregate the landlord's plant and machinery, do a detailed report. That report can then go in the tax return. And for a building like this, there's probably allowances of up to a third of the purchase price. So there could be allowances on the acquisition of 1.5 million. So substantial tax savings available on that 1.5 million of allowances. So that's a reason very often why allowances get missed when you buy buildings. Then in this example, they spent 1 million refurbishing the property. And again, you're probably thinking, well, why hasn't the accountant claimed allowances on the 1 million of expenditure? And the reason normally is because the information that's given to them by the clients is poor. And the invoices just say building works and they're not segregated. The lifts are not separately split out, the air conditioning isn't detailed, or there may be a few invoices which have real figures on, and the accountant will claim allowances on the information they have, but there'll be big lumps of expenditure not segregated, so the allowances are missed. So this is the practical reason why allowances get missed. All property lawyers, all tax advisors, they understand capital allowances, they can read the legislation, they understand it, they have knowledge of what expenditure you get allowances on. But the practical problem is they're not valuers and they can only work with the information which is provided. So this is the real reason why allowances get missed in the UK. There's no magic to it. It's because it's not broken down. And that is when it's time to work with a specialist who can segregate costs. You don't need detailed invoices. They're helpful if they exist. Bills of quantities, price schedules of works are very helpful. But even if there are no cost records available, a specialist can make assessments and disclose those assessments. And HMRC have specialist valuation people within the valuation office who can check this type of work, and they can check that the assessments are reasonable. Who can benefit from allowances? As I've mentioned, the non-tax-paying sector don't benefit, so charities, pension funds, non-profits, no benefit to them. But individuals can benefit, companies, partnerships, offshore investors. And allowances apply to different land interests, so freehold, leasehold. So as you've seen in the previous case study, if you buy an office, you may have entitlement when you buy, and the same, you may have a second entitlement when you fit out or refurbish or spend further monies on the property. What kind of owners can benefit? As we saw from the contaminated land example, property developers can benefit from contaminated land relief, but they are denied claiming normal allowances for plant and machinery. And that is because property developers hold buildings as trading stock. It's not for occupation or for investment. So the only real allowance at the moment that property developers can benefit from is decontaminating land. Occupiers can claim pretty much all allowances, as can investors, whether they're onshore or offshore. As of from April 2020, they can even claim the contaminated land. Individual investors, so that's like me buying a building, I can claim most allowances with the exception of contaminated land. It is thought by Treasury that 150% tax relief for decontaminating land is just simply too generous for individual investors to benefit from. Exempt pension funds don't benefit, but as I mentioned before, you very often have mixed ownership of pension funds. So a tax-paying proportion of a pension fund can benefit from its share of allowances. Pretty much all charities are exempt from corporation tax, so typically no benefit to charities for claiming. How can we make this process more efficient? Well, in practice, we find that the first person to think about capital allowances tends to get the best result. So if we're advising a buyer, we would recommend that they state their position cleanly and simply in an offer letter. And similar wording goes in the heads of terms, and keep it simple. So if it's too legalistic, it will tend to get struck out. But if it's very clear, very simple wording, then you're much more likely to get it agreed. One of the practical problems is if nothing goes in the offer letters or the heads or the contract, and the contract is completely silent, then it can be very difficult. So if you are buying a building, you really want to think what your position is early on in the process and be consistent. And we tend to work behind the scenes with the property agents, with the property lawyers, just to make sure that the wording is effective and it is appropriate for a specific transaction. We see a lot of cases where the wording that is used may have been effective for a previous transaction, completely inappropriate for the current transaction. And if you want to see an example of where capital allowances can go wrong, Google the case of Gley House versus HMRC. It's a good example of where capital allowances can go quite badly wrong. And I would recommend for any property lawyers listening that they may want to limit their exposures in this area. So there are some excellent property lawyers, excellent excellent tax lawyers. We work closely with many firms. We work on a collaborative basis. What we bring to the process is our practical day-to-day knowledge of dealing with HMRC, valuing the allowances. We can very quickly ascertain whether allowances are material or not to a transaction. And most property lawyers welcome us being behind the scenes. And very often, property lawyer, tax lawyer, they will do a report on title. They'll do a section on capital allowances. And I would suggest they may want to limit their PI risk with a paragraph something like this, and suggesting that their clients get some specialist capital allowances advice. It will de-risk it by having some wording like this, either in your engagement letters or in the report on title. Now, a few case studies that illustrate good capital allowances practice. So let's imagine we're buying a building right now in 2020, and we find out that the people that we're buying from are a pension fund or a property developer, and that they've held it from 2005, and before that there was a property developer. Now, this is a kind of golden scenario for capital allowances, because as part of doing this forensic process, we've identified that no one has previously been entitled to claim any capital allowances. Pension fund, property developers, not able to claim capital allowances. So the person who's buying this building now in 2020, even though that building might be quite old, even though the plant and machinery in the building may be quite old, can then have entitlement to claim general pool allowances and integral features allowance. And they may also get some of the relatively new structures and buildings allowances. So this is a golden scenario. So if you can buy from non-taxpayers, it's likely you get more capital allowances. The tax legislation enables us to piece together forensically the history and the ownership to ascertain what allowances are available to the buyer. So in this example, a lot of accountants wouldn't have claimed because there would be nothing in the contract. The contract would have been silent because no one has claimed allowances before. So a lot of opportunity. If this was an office, probably straight away 30% of the purchase price could attribute to capital allowances. Second scenario, again, we're advising a buyer in 2020, and we find out that the previous owner bought it in 2007, and they claimed capital allowances of $1 million, and they early in the process said you can only have £1 of allowances. This is a fairly common scenario, so seller's been well advised, and the seller will be able to keep all of the $1 million that they've claimed by putting in a tax election in the contract for £1. So a nice position for the seller, a not so good position for the buyer, because on the face of it, the buyer just gets allowances of £1. Now, most accountants, most tax advisors, they would just accept they would get £1. However, a capital allowances specialist would figure out from the dates that the seller, because they bought it in 2007, was not entitled to claim post-2008 integral features. So in most cases, the buyer would then be able to make a top-up claim for general lighting, general power, cold water, solar shading. And that could be 10, 15% extra allowances on top of the £1 tax election. So again, not quite a golden scenario as the one before, but certainly a silver scenario that the buyer was expecting just to get £1 worth of allowances, but without cooperation from the seller in this example, the buyer can get extra allowances. And you may find out as part of the due diligence that the seller has done recent refurbishment and maybe not claimed allowances on that recent refurbishment. So there may be scope to claim even more allowances. Another case study here. Let's imagine you have the great fortune to be advising the very happy Donald Trump. And surprisingly, he has buying a building from his best buddy, Joe Biden. And you find out from the history that it was previously owned by another great friend, Putin. And as part of the process, you work through the tax history and you find out that Putin claimed allowances of 20 million, Biden has claimed nothing. And the reason for that, most probably, is that Putin, well advised, put in a tax election for £1, kept all his 50 million of allowances. Now, does that mean that Donald gets nothing? It could do. A lot of accountants, a lot of lawyers would say, yeah, the seller, Joe Biden, has claimed no allowances. There are no allowances available. However, there might be a couple of opportunities here. And we can see again from the dates that Joe bought this building in 2009. So there could be unclaimed integral features. And it may be necessary to get Joe to pool or claim those allowances and transfer across those extra allowances to Donald within 2 years of completion. So there may be the scope to claim extra integral features. And we know that Joe's son loves having parties, so he's probably put in lots of party fittings, saunas, swimming pools and the like. And so Joe's probably spent money on that building during his ownership. And as part of the due diligence, we find out he has claimed no allowances on his refurbishment expenditure. So again, potentially Donald could get extra allowances from Joe on Joe's actual expenditure incurred during his ownership. There are other further opportunities to get more allowances. They're probably beyond the scope of this webinar, so I won't go into them. But again, what this slide does is it illustrates that very often more allowances can be pulled out of a transaction. Not always, but at least in probably 50-60% of cases, we can get more allowances if we're involved early, if we can work with the property lawyers, if we can get some wording in the sale and purchase contract that says who's going to do what and when. So as we've seen from the last few examples, if you've got situations where you've signed a tax election for £1 or for a low amount, it may be possible to get extra allowances. And that's an example where it's worth engaging a firm like ours to have a look, do a high-level look back to see can more allowances be claimed now. There are lots of misconceptions in this area. People do get hung up on time limits. There are time limits for claiming allowances in a particular year end, but if you miss those time limits for a specific year end, then you can normally claim in a later period, provided you still own. So it is seldom too late to claim allowances. A lot of accountants think that if you claim these allowances, the benefits will get clawed back on a sale. That's not true for plant and machinery. So as we saw with Putin, he was able to structure it to keep all of the benefits, and he didn't pay any extra tax as a result of keeping the capital allowances benefit. And you will not pay more or less capital gains tax if you claim allowances. One exception is if you claim the relatively new structures and buildings allowance, which I'll talk about in a little bit more detail. And a lot of people will say, yeah, this is interesting, John. Yeah, thanks for the webinar, but our accountants deal with this. Now, just be a bit skeptical as to that, because unless they're working with capital allowances specialists, they will only be claiming the very simple, the very routine allowances and be potentially missing the more complex allowances to which you are legitimately entitled. Another case study here, a quite recent one. Somebody bought some industrial office mixed use from a property developer for 1.4 million. It was relatively recent, and then after acquisition, they spent £500,000 fitting out this building, and their accountants hadn't claimed any allowances at all. Now, by visiting the property, segregating the costs, you can see that we got allowances on pretty much all of the 1.4 million, with the exception of the land cost. In the UK, it's not possible to claim allowances on land costs. So substantial allowances available on purchase, and the same when it came to fit out. They got complete tax allowances on all of the fit out. So overall, out of their total expenditure of 1.9 million, they got allowances of 1.65 million compared with their starting position, which was 0. Another case study here, actual case study. This was a restaurant, and they spent 2 million refurbishing the restaurant, and they hadn't claimed any allowances. So the information was poor. They'd fallen out with a contractor. Contractor had gone bust, and the accountant was asking for records, information, but nothing was forthcoming. And they then engaged Level Consulting. Even though the records were poor, we managed to recreate them by doing detailed cost plans. We amended their earliest tax returns that we could go back, which triggered a refund of tax. And out of the 2 million, we got allowances of 1.7 million, whereas previously they'd claimed 0. So, there's no magic in what we did. It's just a segregation of the costs in a lot of detail in a something like a 50-60 page report, which then is included by your existing tax advisor in the tax return. If there are any questions from HMRC, we deal with those questions to get an agreed position. And in 23 years, all of our work has been agreed with HMRC. We have not had a single case rejected. We sometimes get adjustments to our work, but those adjustments tend to be quite small. We don't replace your accountants. We don't replace your tax advisors. We work alongside them. Briefly, I'll cover the structures and buildings allowance. I'm not going to go into a lot of detail. But most of the allowances we've talked about so far relate to plant and machinery or repairs, things like heating, air conditioning, lighting, and the like. But a relatively new allowance is structures and buildings allowance, which gives tax relief for commercial buildings on the building structure expenditure and hard landscaping. These allowances do not apply to stamp duty. They don't apply to legal fees. They don't apply to soft landscaping, but they apply predominantly to the bricks and mortar in a commercial building. I'm going to skip over some of the detail in the slide. We do, if anyone's interested, we've published in Tax Journal an article about this specific allowance. Happy to explain it in more detail. It's a relatively simple allowance. The disadvantage of claiming this allowance is the benefits get clawed back if you sell an asset. So if you claim this in, say, a property company, hotel company, and then you sell the asset out of that company, the benefits of claiming this specific allowance are largely clawed back on sale. So it's a lot less generous than claiming plant machinery allowances. What are capital allowances cashback opportunities? We've kind of gone through those in the case studies. It's essentially getting repayments of tax that you've previously paid. And have a look back at those examples to see whether you think you're entitled. And you can get cash back for plant and machinery, for the energy efficient plant, and very generously for the land remediation. As I've mentioned more than once, the best takeaway from this webinar is the opportunity to revisit historical expenditure and to claim the missed allowances, claim the extra allowances in current or open tax returns, or even in future tax returns. But given that most companies are paying a lot less tax in the corona period, a lot better if you can to claim these allowances when you had substantial income tax or corporation tax bills. Another example here, a non-resident landlord. They bought a property 6 years ago for 10 million. They didn't claim. There were missed allowances of 2 million. They also missed claiming allowances on the refurb. So total extra allowances of 3 million. Now, they could claim in any open tax return substantial saving, 3 million of allowances at 19% corporation tax. By amending the previous year, he'll actually be able to get a tax repayment from HMRC and probably some interest as well on that repayment. Very simple, easy to do. Same for contaminated land, 150% tax relief. It's got quite a wide definition, so it includes Japanese knotweed, asbestos, in some cases diverting services. It applies to both developers and investors. With this one, there are time limits, generally in 2 years. You may be able to squeeze it out beyond 4 years, depending on the timing of the expenditure and the particular year ends. We can do a high-level review to look back to see what scope there is. You can even claim this allowance if you've sold sites, provided they were sold within the last 2 to 4 years. And as I mentioned, it's wide in scope. It tends to be underclaimed in practice, and the reason it's underclaimed is because it's not segregated. It's very often the costs of decontamination appear in construction headings like substructure, excavation, earthworks. They're very dull, they're very boring headings, and people don't go looking for allowances in them. But that typically is where the decontamination costs are hidden. A specialist may need to look at geological reports, may have to look at soil reports to ascertain what type of contamination has actually been carried out, and then to estimate the costs. We've kind of covered getting repayments for energy efficient plants. It is thought that the carbon trust allowance, which was scrapped in April 2020, may be back on the table in the next year or two. That's subject to the Treasury, who have a lot of other things to consider right now, but I would expect there will be a future incentive for energy efficient plants. And the trick with capital allowances is to segregate the expenditure into the categories that give the best tax relief. So to allocate first to the 150% tax incentives, then to the 100%, right down to the structures and buildings allowance, which you can currently claim at 3% a year. So it's a segregation exercise into the different pots of allowances. What will happen going forwards? I've been doing some lobbying with government ministers to try to increase the annual investment allowance. It's currently 1 million. The first million that you spend on plant and machinery of any type, you can write off all in the first year. Currently, as it stands, this will drop to 200,000 in January 21. I would expect the Treasury will increase that 1 million, maybe to 5 million, or worst case, keep it at 1 million. I think it'd be very detrimental to the economy if it drops down to 200,000 right at the point in the business cycle when we need more investment in the UK economy than ever before. There has been a consultation paper on free ports. I think there's going to be something like 10 sites around the UK, mainly around airports, around ports, and they have indicated that there will be considerable tax investments for capital expenditure, that there'll be increased annual investment allowance, there might be enterprise zones, and there may be faster structures and buildings allowances. So I would say watch this space in terms of free ports. How we can help, I've kind of gone through that with the various slides. Any questions after the seminar, I'll be delighted if you send me emails to reply to you one-to-one. As I've mentioned, I can see there's a few questions. I will separately, after this webinar, email out to all of you the responses, and there are my contact details. I'd like to thank you for listening to this webinar, for your patience. We've had a very good attendance, and I wish you all good health and an excellent week. Thank you.